Did you know that Canada's multifamily real estate vacancy rate has reached a 5-year high? This is a significant development with implications for investors and tenants alike. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. According to a recent report from Yardi, Canada's multifamily real estate vacancy hit a 5-year high for the second straight quarter. The vacancy rate rose by 110 basis points year over year to 4.3% in the third quarter, and increased by 20 basis points from the half-decade high of 4.1% posted in the second quarter. Notably, Montreal experienced the largest vacancy increase in the third quarter, with the rate climbing 1% year over year to 5.6%, following a 3.3% rise in purpose-built rental housing inventory. In contrast, Calgary maintained the highest vacancy rate at 5.8%, though it saw a decrease of 90 basis points quarter over quarter. On the other end of the spectrum, Winnipeg and Halifax recorded the lowest vacancy rates at 2.4% and 2.8% respectively. The market's deceleration comes amid weakening demand and slowing new lease rent growth, following several years of above-trend increases. However, Yardi's findings suggest the market remains healthy, even as the Canadian economy grapples with rising United States tariffs and weakening employment. Yardi's report highlights that former market leaders like Calgary saw lease-over-lease rents fall by 3%, and average bachelor unit vacancy reached 6.7%, the highest among all unit types. Toronto's bachelor suite vacancy rate was significantly above the national average at 8.9%. Despite these challenges, the average national in-place rent increased by $14 to $1,734, although the annual growth rate dropped by 90 basis points year over year to 3.9%. Halifax, buoyed by its burgeoning technology market, experienced the most substantial year-over-year in-place rent increase at 5.9%, with rents rising by $29 to $1,634. Edmonton, Saskatoon, and Montreal also posted strong rent gains. Conversely, Calgary, Ontario's Kitchener-Cambridge-Waterloo region, and Toronto experienced the lowest increases. Halifax also led in new lease rent increases, while Ottawa, Gatineau, and London, Ontario tied for second, and Montreal ranked third. Calgary, Hamilton, Kitchener-Cambridge-Waterloo, Toronto, and Vancouver were the worst-performing markets for new lease rent growth. Allied Properties Real Estate Investment Trust, one of Canada's largest publicly traded office building owners, has seen its unit price fall by 17%. This sharp decline followed management's indication that a distribution cut might be on the horizon due to ongoing struggles with a heavy debt burden and muted office leasing activity. This is a significant development in the commercial real estate landscape, especially for investors who have been closely monitoring Allied's financial health. Allied has been known for its low-rise office buildings in downtown cores across Canada. For months, there have been questions surrounding its monthly distribution, which totals approximately $250 million annually. Despite previous assurances of sustainability, the company is now considering a distribution cut in 2026, as stated by Chief Executive Officer Cecilia Williams. This move aims to strengthen the balance sheet, reflecting the challenging leasing environment. The company had initially projected a 90% occupancy rate across its portfolio by year-end. However, they have recently adjusted this target, expecting instead to reach around 84%. This lower occupancy rate means less revenue from leases, thereby limiting the cash available for distributions. For investors, this is a double blow, especially considering the optimism that return-to-office mandates from large institutions might boost leasing demand. Before the COVID-19 pandemic, Allied Properties was a favorite among investors, with its low-rise buildings and high demand from businesses in the creative and innovation sectors. However, the landscape has shifted significantly. According to CBRE, the national vacancy rate for downtown Class A office buildings, those in prime locations with top-notch amenities, stands at 16.1%. This has affected leasing demand and, consequently, Allied's market performance. In an effort to manage its debt, Allied sold data centers in downtown Toronto for $1.35 billion in 2023. While this generated much-needed cash to pay down debt and support its development portfolio, the pace of debt repayment has not been as rapid as anticipated. This ongoing issue with debt has been a significant factor weighing on the company's units. As Canadians navigate the evolving landscape of income, pensions, spending, and wealth, there's a lot to consider in terms of how these factors interact with the real estate market. A recent release by Statistics Canada provides some valuable insights that could be particularly relevant for investors in the multifamily real estate sector. According to the latest data, the average after-tax income of Canadian families has seen a slight decline in 2023. This downturn may affect consumer spending habits, potentially influencing demand in the rental market. It's crucial for real estate investors to understand these economic shifts as they strategize their next moves. On the pension front, trusteed pension funds reported stable growth in the first quarter of 2025. This stability is a positive sign, as it suggests that Canadians might maintain or even increase their investment in real estate as part of their retirement planning. Real estate remains an attractive asset class for diversifying retirement portfolios, given its potential for steady cash flow and long-term appreciation. The survey of household spending reveals that Canadians are adjusting their spending patterns in response to rising costs. This is where the multifamily real estate market can offer a silver lining. With more Canadians looking to optimize their living expenses, multifamily properties could see increased demand as people seek more affordable housing options. The Canadian Income Survey highlights that nearly half of Canadians are feeling the pinch of rising prices, impacting their ability to meet everyday expenses. This presents an opportunity for multifamily investors to cater to a growing demographic seeking cost-effective housing solutions. By focusing on affordability and quality, investors can attract a broader tenant base and ensure steady occupancy rates. While the economic landscape presents challenges, it also opens up avenues for strategic investment in the multifamily sector. By staying informed and adaptable, investors can navigate these changes effectively and capitalize on emerging opportunities. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.